In the early 2000s, almost everyone believed the same thing. Housing prices only go up. Banks know what they're doing. Risk has been engineered away. And if something ever went wrong, the system would handle it. That belief would nearly collapse the global economy. The 2008 financial crisis wasn't caused by a single bad decision. It wasn't caused by greedy homeowners or reckless traders alone. It was caused by a perfect alignment of incentives where everyone made rational choices and the system still broke. This is the story of how a crisis that started in American housing spread across the world, froze global finance, destroyed trillions in wealth, and changed the rules forever. And more importantly, why the lessons of 2008 are already being forgotten. After the dot-com crash, policymakers were terrified of another recession. Interest rates were pushed lower, credit became cheap, borrowing was encouraged. Homeownership was no longer just a personal goal. It became economic policy. Banks began issuing more mortgages, then riskier mortgages. Then, mortgages to people who clearly couldn't afford them. These were called subprime loans. But here's the key mistake people make when they hear that. The problem wasn't that banks made bad loans. The problem was what they did after. Banks didn't want to hold these mortgages. So they bundled thousands of loans together and turned them into securities, mortgage-backed securities. These bundles were then sliced, repackaged, and sold to investors around the world. Pension funds, insurance companies, banks in Europe and Asia. And here's where the system broke. Rating agencies labeled many of these products as safe, even when they were built on fragile loans. Why? Because the math assumed that housing prices would never fall everywhere at the same time. That assumption was wrong. But while prices kept rising, the illusion held. Another word you must understand to understand 2008 is leverage. Leverage means borrowing money to amplify returns. Banks weren't just investing their own capital. They were borrowing enormous sums to do it. Some institutions were leveraged 30-1. That means a 3% drop in asset value could wipe them out. But during the boom, leverage looked brilliant. As long as prices went up, everyone looked smart. Until they didn't. In 2006, housing prices began to stall, then fall. Defaults increased. Mortgage payments stopped. The value of mortgage-backed securities collapsed. But the real danger wasn't the losses. It was uncertain. No one knew who held what. No one trusted anyone else's balance sheet. Banks stopped lending, even to each other. Liquidity vanished. This is when panic begins. In September 2008, Lehman Brothers collapsed. It wasn't the biggest bank, but it was the moment confidence died. When Lehman was allowed to fail, markets realized something terrifying. Not everyone would be saved. Stock markets crashed. Credit markets froze. Global trade slowed almost overnight. What started as a housing problem became a global financial crisis. Faced with total collapse, governments and central banks acted. The Federal Reserve cut rates to zero. It injected liquidity into the system. It created emergency lending facilities. Governments bailed out banks. Not because they loved them, but because letting them fail would have destroyed the economy. This is where public anger exploded. Banks were saved. Ordinary people lost homes, jobs, and savings. The system survived. Trust did not. After 2008, interest rates stayed near zero for years. Central banks became permanent market participants. Debt replaced growth as the main stabilizer. The crisis taught institutions one lesson: the system must never be allowed to collapse again. But it taught ordinary people another: losses are socialized. Gains remain private. This imbalance still defines modern finance. Most people think 2008 is history. It's not. The structures created to save the system became permanent features: low rates, high debt, central bank intervention. The crisis didn't end the system. It reshaped it. And many of the risks that built 2008 still exist, just in different forms. The 2008 financial crisis wasn't caused by stupidity. It was caused by incentives. Everyone acted rationally, and the outcome was still catastrophic. That's the real danger of complex systems. And that's why understanding financial history isn't optional. Because crises don't repeat exactly. They rhyme.